Hi, my name's Eric, and I'll be reading you selections from Barrons magazine on behalf of the Audible Local Ledger, a reading service for people who are blind or print disabled. We'll start with Up and Down Wall Street. By the way, this is the June 23rd, 2025 edition. The longer the market waits, the more fragile it looks. President Donald Trump needs 2 weeks, and the stock market may need even longer to get its rally going again. With the war between Israel and Iran showing no sign of letting up, the question of whether the U.S. will get involved hangs over the conflict. That decision could determine whether the hostilities escalate even further, possibly leading to attacks on American soldiers and the closing of the economically important Strait of Hormuz. Trump, however, needs a fortnight to decide, and so the market waits. The Middle East has also been a distraction from negotiations between the U.S. and its trade partners. Investors hoping that Trump would leave this past week's G7 meeting with at least a tariff deal or two were disappointed when the president departed early, with only the previously agreed-upon deal with the UK signed. Meanwhile, the Trump-imposed July 9th deadline for signing these deals is fast approaching, and so the market waits. Trump's big, beautiful bill continues to be tinkered with by Congress, which is haggling over cuts to Medicaid, green energy incentives, and the level of state and local tax caps. There's a deadline there, too. The Senate and House would like to have it sealed and delivered by the July 4th weekend so it can be signed by the president. And so the market waits. Nor is Trump the only one who needs more time these days. Federal Reserve Chair Jerome Powell, surprising no one, left interest rates unchanged at Wednesday's meeting of the Federal Open Market Committee and suggested he needed months, not weeks, to make a decision on whether to cut or not. And so the market waits. From a risk management point of view, the 2-week pause on the U.S. potentially striking Iran is another reason for investors to remain in wait-and-see mode, writes Dennis DeBuscher, chief market strategist at 22V Research. Investors must also wait and see what the impact of tariffs will be on inflation and how the Fed will react to that inflation and what will happen with the budget. Any of those events could upend the stock market, but the S&P 500 is less than 3% away from its all-time high, as investors wait and see what happens. The index closed down 0.2% this past week after dropping just 0.4% the week before. All told, it's been in a 2-week range of 1.8 percentage points, the narrowest since the 2 weeks ending December 13th of 2024. Imagine where the market might be in a world without a crisis, writes Wellington Shields analyst Frank Gretz. Imagine, because it's not reality. There's always something. However, were we to just suppose, the market itself seems in a happy place. It's not as if financial markets are ignoring all the risks. While the CBOE Volatility Index, or VIX, has been relatively muted since the fighting began in the Middle East, the CBOE Crude Oil ETF Volatility Index spiked close to a 5-year high, notes Citigroup strategist Scott Cronert. Such divergences aren't all that uncommon. Oil volatility barely budged when the VIX spiked in April due to tariff worries. Geopolitical tensions have been mostly ignored by equities, but they're being factored into oil, he writes. The stock market's also becoming less sensitive to changes in volatility. Typically, a rise in the VIX is met with a big move in the stock market as well. That was the case earlier this year when the S&P 500 dropped nearly 20% as volatility surged because of Trump's tariff plans. Since then, the benchmark index has become less responsive to moves in the VIX, according to data from Quant Insight, suggesting that the risk appetite is stronger than it looks. Intuitively, when fear is high, we would expect the index to be highly sensitive to rises in VIX, the firm's analyst write. In contrast, when there's greed, sensitivity would likely be low. And there are hints that all is not quite right under the surface. For one, the number of stocks participating in the rally has stalled since the initial jump off the April low. The SPDR S&P 500 exchange-traded fund has returned 0.4% over the past month, including reinvested dividends, with tech strength helping to keep it afloat. The Technology Select Sector SPDR ETF is up 3% during that period. Yet the Invesco S&P 500 Equal Weight ETF has fallen 1.5%, a sign of general weakness in the average stock. Fund Strat technical analyst Mark Newton notes that the percentage of stocks trading above their 200-day moving averages, a measure of long-term strength, has slipped below 50%, while the percentage above their 20-day moving averages has fallen below 40%. This is a bit of an advanced warning system towards pointing out why it's possible for U.S. equity markets to fall if technology itself starts to stall out, as many other parts of the U.S. stock market have not been working since mid-May, he writes. Taken together, the evidence suggests that the stock market is more fragile than it appears on the surface, and that the longer investors are forced to cool their heels, the more their patience will be tested. Investors, unlike the president, don't always have the luxury of time. Those looking for the next hot artificial intelligence stock could do worse than Chevron and ExxonMobil. On the surface, that seems like a wacky notion, akin to suggesting that William T. Vollmann should write young adult novels. Chevron and Exxon are dinosaurs, after all, and not the kind you find in children's books. They're exploring for last century's energy, rather than preparing for the next. But as can be seen by the sudden sexiness of drab utilities like Vistra and Constellation Energy and industrials that service power plants like GE Vernova and Mastech, AI needs power, and lots of it. And what are Exxon and Chevron if not companies designed to help supply power? For investors willing to look past their preconceptions, the two oil majors might just be the best AI bargains going. It's tempting, of course, to stick to NVIDIA, Meta Platforms, and other big tech stocks that look to have the AI edge, yet figuring out who's ultimately the winner or loser among them may be harder than it looks, according to Gurveer Grewal, a global research analyst at William Blair. AI may allow companies to cut costs and innovate their products, but that won't necessarily translate into higher profit margins. For companies without strong moats, AI tools may just be the cost of doing business, and they'll have to cut prices to keep their customers. AI will likely be a strategic investment rather than an economic investment for many businesses, as they invest in AI not for immediate revenue or cost savings, but simply to remain competitive, Grewal writes. It's one reason so many AI plays simply fizzle out. Supermicrocomputer, which rallied 318% from the end of 2023 through its March 2024 high after becoming an AI darling, before dropping 85% through its November 2024 low, comes to mind. And it's also why it's difficult to know whether a stock like Duolingo, which has rallied on AI hopes, can sustain its gains. One of the best places to be might be power. AI is a power play, quite literally. The massive data centers driving the AI revolution require massive amounts of electricity to run, and power production is finally growing after years of stagnation. That's helped lift everything from the utilities providing the power to the companies helping to build and maintain them, including Amphenol and Vertiv Holdings. The risk, of course, is that too much power is being built out, perhaps more than will ever be needed. Overbuilding was a problem for independent power producers in the past, with Calpine filing for bankruptcy in 2005 and Energy Future Holdings following suit in 2014. Such overbuilding is unlikely to occur now, according to Raymond James analyst J.R. Weston. For one, there's very little building going on. Instead, utilities have been focusing on upgrading and restoring mothballed power generators to handle the new power needs. It's also unlikely they'll be able to overbuild due to regulations and other factors. On the flip side, investors may be underestimating just how much power is needed. Data centers are just the beginning, according to 22V Research's Jordi Visser, who sees it being used in robots, self-driving cars, smart appliances, and other products that will require even more power. Unlike traditional data centers that are concentrated and centrally planned, embodied AI will generate a vast, decentralized layer of 24/7 compute demand embedded in warehouses, hospitals, homes, vehicles, and factories, he writes. These edge applications won't tolerate latency or downtime, making local dispatchable power essential. The change has been significant enough to cause a repricing of independent power producers across the utility sector. Vistra now fetches 25.1 times 12-month forward earnings, up from 15.5 times 1 year ago, while NRG Energy trades for 18.6 times, up from 11.3 times. And it's a big reason that Raymond James initiated the two stocks with strong buy ratings, and Constellation and Talon Energy outperform. We continue to like the setup for most names on the broader power theme, Weston writes. Yet, Exxon and Chevron are still viewed as stodgy oil companies, not AI beneficiaries. That could change, 22V's Visser claims. Both companies are primed to benefit from demand for natural gas-fired power, he argues, especially if there's likely to be an energy shortfall. Chevron, for instance, has partnered with GE Vernova and Engine Number 1 to expand gas power for data centers, while Exxon has touted its ability to supply power to big tech firms long before nuclear power can become a realistic option. Despite these developments, the market continues to value Chevron and ExxonMobil primarily as cyclical oil companies, Visser writes. It has not yet priced in the possibility that these firms will become direct electricity suppliers to hyperscalers, a role that could warrant higher valuation multiples. Even following their recent surge, thanks to rising oil prices, Chevron and Exxon trade at 17 and 16 times 12-month forward earnings, respectively. If an AI premium gets included in the stock, they could be worth a heck of a lot more. That was written by Ben Levison. Streetwise column is next, from the Barrons of June 23rd. Humanoid robots are finally here. How to invest, by Jack Huff. Humanoid robots are hot, apparently. A China stock index of companies involved with their development is beating the world market by 16 points this year. A new report from UBS says the world will have 300 million humanoids by 2050. An earlier one from Morgan Stanley puts the number at 1 billion. And the size of the market by then at $5 trillion, twice what the top 20 car makers bring in today. There are loads of stock picks, for those so inclined. Among UBS's favorites are NVIDIA, a rare earth metals producer called Linus, Honeywell, Taiwan Semiconductor Manufacturing, Cognex for machine vision, and Amphenol for sensors. Morgan Stanley likes Tesla, NVIDIA, and Alphabet, and just published a Humanoid 100 index of companies making all sorts of robo-doodads, from planetary roller screws to harmonic reducers. For investors who want one-click exposure, there's the newly launched Crane Shares Global Humanoid and Embodied Intelligence Index Exchange Traded Fund, ticker KOID, which costs 0.69% a year. It's entirely possible that this investing theme is both too late and too early. Many of the stocks have run, and the production ramp might not hit big numbers for the better part of a decade. Personally, I'm an anti-themist, preferring to let an S&P 500 fund handle the Darwinian allocation of big companies strangling new markets for profits. But for the robo-curious, let me run through some basics. Remember back when those videos popped up on YouTube with a headless four-legged robot from Boston Dynamics that could walk and jump and keep its balance when pushed? That was Big Dog, created in 2005 with funding from the Defense Advanced Research Projects Agency, or DARPA. It never made it out of boot camp. The gasoline engine was deemed too loud for combat, and the battery version couldn't carry enough weight. Today, for $1,600 in China or $2,500 on Amazon.com, you can buy a Unitree Go-To robot dog that can run, sit, shake hands, stand on its front legs, and kick its back legs in the air, and even move autonomously, once the space has been mapped with LiDAR. Amazon's page calls this a toy. Unitree calls it a partner. For $16,000 in China, or just over $27,000 with U.S. shipping from robotshop.com, you can step up to the Unitree G1 humanoid robot. Humanoid meaning human-like in appearance, with 2 arms, 2 legs, a head, and optional dexterous hands. Unitree calls this an agent. It can hop on 1 leg, crack nuts, open bottles, and flip pancakes. Not simultaneously, so far as I know. One thing it can't do at just over 4 feet tall is reach top shelves. There's a much more advanced version that's nearly 6 feet tall called H1 that starts at $90,000 in China. In a 2013 article on robots, I highlighted 3 industrial players. Since then, Rockwell Automation and Switzerland's ABB have quadrupled shareholder money in dollar terms. Germany's KUKA was bought out by China's Midea, an appliance maker, in 2016. In a 2017 cover story, I mentioned those stocks along with the Global Robotics and Automation ETF, which has since underperformed the market. Japan's Fanuc, which has managed to lose money. Amazon and Alphabet, which have been winners, and a chip maker that was still 5 years away from becoming mostly an artificial intelligence player. Chips from companies with video game expertise like NVIDIA make quick work of the heavy thinking, I wrote. That one is up more than 5,000%. Those stories were mostly about hulking mechanical factory arms that perform specific repetitive tasks. The rise of robots in humanoid form makes sense in part because, as NVIDIA founder and CEO Jensen Huang has explained it, we built the world for ourselves. Early versions can perform factory work like sorting items and carrying boxes. The end game, according to Morgan Stanley, is lifelike robots performing generalist roles. Think firefighting, nursing, cleaning, and companionship. It reckons that by 2050, capable humanoid robots will cost around $50,000 in rich countries and $15,000 in low and middle income ones. China's players are getting a government nudge. Last year, the country's Ministry of Industry and Information Technology issued guidelines for humanoid robot production, with the goal of making them an important element of economic growth by 2027. In the U.S., Tesla plans to release a humanoid robot called Optimus by next year, costing less than a car. One way to compare humanoid robots is with hand movement and what's called degree of freedom. Human hands have a DOF, or degree of freedom, of 27. The entry-level Unitree robot can be upgraded to a DOF of 7. Tesla's latest Optimus prototype has one of 22. The highest value part of humanoid robots will likely be the data models, called VLA, for Vision Language Action. These can be trained using videos and simulated data, but the best model training comes from time-consuming laboratory work involving humans wearing sensors. China has a manpower advantage there, analysts say, while the U.S. leads on chips. Tesla has an opportunity to become an integrated robot maker that controls its own VLA model. One thing all humanoid robots are likely to need is magnets, and those require rare earth metals like neodymium and praseodymium, of which supplies are limited and largely China-based. Australia's Lynas is a key producer of both of these and another UBS favorite. Lynas and a U.S. rare earths player called MP Materials are top 5 holdings in the aforementioned CraneShares ETF. UBS expects the humanoid robot arrival to begin with a trickle, perhaps only 2 million units worldwide by 2035, but to quickly become a flood as prices fall and capabilities improve. Maybe by then, I'll be ready to try again at robot companionship. The last unit I befriended, a knocked-off Roomba, kept trying to throw itself down the stairs. Up next is the review and preview section. There's always a little bit of a story, and then last week and this week and the numbers. Buffett Plus in an ETF. An exchange-traded fund keyed to Warren Buffett's Berkshire Hathaway equity portfolio has attracted nearly $250 million since its inception in March. The Vista Shares Target 15 Berkshire Select Income ETF holds 21 stocks, 20 in Berkshire's portfolio, plus 10% of its assets in Berkshire's Class B shares. Plus, there's a twist. Berkshire doesn't pay a dividend, says Vista Shares CEO Adam Patty. We felt there was an opportunity to mirror the holdings and provide a 15% target annual yield. The Berkshire ETF uses the sale or writing of call options to augment income. As a result, the Berkshire ETF may be best suited for tax-free IRAs and 401k accounts. Any income strategy will not keep up in an aggressive bull market due to the options, Patty says, but the income will offset some stock price declines. The annual fee is 0.95%. The total return of the ETF, which closed Friday at $19.20, is about flat since inception. The Berkshire index it tracks, which includes Apple, Berkshire B shares, American Express, and Coca-Cola, has fallen about 4%. We want as much upside as possible, but not to the detriment of hitting the 15%, says Patty. Vista Shares has also filed for actively traded ETFs that will invest in the publicly disclosed holdings of Bill Ackman, Stan Druckenmiller, and Michael Burry, both with and without options. They could hit the market by Labor Day with a new option-free Berkshire ETF. And that was written by Andrew Barry. Last week in the markets, Israel hit Iranian oil and gas depots and oil and gold edged up. But Persian Gulf shipping continued. President Trump left the G7 meeting early, telling Iranians to fly Tehran and unconditionally surrender, quote unquote. The administration reversed its retreat on deportations in agriculture, hotels, and restaurants. The Federal Reserve held interest rates steady. Fed Chair Powell warned of inflation and tariff risks. Trump delayed his Iran decision for 2 weeks. On the short Juneteenth week, the Dow Industrials rose 0.02%, the S&P 500 fell 0.15%, and the Nasdaq Composite gained 0.2%. In companies last week, SoftBank Group sold $4.8 billion of its T-Mobile U.S. stake to fund AI plans. Senate Republicans' tax and spending plan restored the SALT tax deduction to $10,000, curtailed and delayed the foreign investment provision, and retained cuts to solar and wind tax credits. Macquarie Asset Management raised $8 billion for infrastructure investments. A SpaceX Starship exploded, this time during testing. The Senate passed the Genius Act, regulating crypto. Microsoft plans more job cuts, mostly in sales. In deals last week, an Abu Dhabi state oil company-led consortium bid $19 billion for Australian energy company Santos. U.S. Steel and Nippon Steel completed their deal, with the U.S. claiming power over key decisions via a so-called golden share, though details were vague. Home Depot made a bid for building products distributor GMS after Brad Jacobs' QXO offered $5 billion on Wednesday. What's coming up this week? On Monday, June 23rd, S&P Global releases both its manufacturing and services purchasing managers indexes for June. Consensus estimates are for a 51 reading for the manufacturing PMI and 52.7 for the services PMI. Both estimates would be 1 point less than the respective May figures. In Tuesday, June 24th, FedEx reports quarterly results on Tuesday, followed by Micron Technology Wednesday and Nike on Thursday. Federal Reserve Chairman Jerome Powell delivers his semi-annual monetary policy report before the House Financial Services Committee on Tuesday. He'll do the same before the Senate on Wednesday. Powell might be pressed by President Donald Trump's GOP allies as to why the Fed hasn't cut interest rates this year. And on Friday, June 27th, the Bureau of Economic Analysis releases the Personal Consumption Expenditure Price Index for May. Economists forecast a 2.3% year-over-year increase, 0.2 of a percentage point more than in April. The core PCE is expected to rise 2.6% compared with 2.5% previously. The annual change in the core PCE, the Federal Reserve's favored inflation gauge, is at its lowest level since March of 2021. In the numbers, 40%. That's China's share of the 2024 global robotics market, or $47 billion, expected to grow 23% annually through 2028. $11 trillion. That's crypto transaction volume in 2024, up 56% from 2023. Illicit transactions dropped 24% to at least $45 billion. 7%. The increase in U.S. government interest costs over the past 8 months to some $776 billion. And $43 trillion. Total U.S. retirement assets as of March 31st. That's down 1.6% from December and 34% of all household assets. The next headline in the Barrons magazine edition of June 23rd. Are credit card perks worth the higher fees? Chase's Sapphire Reserve credit card is charging $795, topping the Amex Platinum card. We size up the slew of rewards these cards offer, by Abby Schultz. Premium credit cards that offer access to airport lounges and generous rewards for travel are getting more expensive and more complicated. The question for consumers, are they worth it? Chase Sapphire Reserve, one of the most popular, announced on June 17th that it was hiking its annual fee by 45% to $795, topping the already steep $695 annual fee for the American Express Platinum card. Sapphire Reserve was introduced in August of 2016 with an annual fee of $450. Though these cards are pricey, consumers flock to them for the slew of rewards that can easily dwarf the fee. Sapphire Reserve's new menu of travel, dining, and entertainment perks can add up to more than $2,700 in annual value, according to the Points Guy, a card tracking website. By redesigning the card to tap into all of JP Morgan Chase's assets, the bank was able to increase the fee by only a small fraction of the incremental rewards and benefits the customers will get, says Chris Reagan, Chase's president of branded cards. Still, $795 plus $195 for each authorized user is serious money, says Clint Henderson, the Points Guy's managing editor. I've always argued that most consumers can get more than the value from the annual fee on these high-end cards, but consumers will really need to become experts to make sure that remains the case going forward. Credit card fees are critical to issuers. From 2015 to 2022, fee volume more than doubled industry-wide to $6.4 billion, according to a 2023 report by the Consumer Financial Protection Bureau. There's a good chance that American Express Platinum cardholders may also see their already sky-high annual fee escalate. Amex, the elder statesman of the premium card market, announced on June 16th that major updates are in store later this year for both the Platinum and Platinum Business cards. Amex spokeswoman Elizabeth Crosta said that the company had no additional details to share, including whether fees would go up. Henderson expects that Amex will want to retain its exclusive position as the most expensive card on the market. I think we'll see a $995 annual fee for the Platinum card, he says. Amex really doesn't have to worry about its hold on exclusivity. The Amex Centurion, or Black Card, an invitation-only charge card that the company doesn't publicize, requires an initiation fee of at least $10,000 and an annual fee of $5,000, according to several published reports. Amex doesn't provide details. Both the Sapphire Reserve and Amex Platinum cards offer points on purchases that can be applied to flights and hotels, in addition to statement credits, which are credits made to a consumer's monthly statement for specific purchases. Chase is doubling down on statement credits with its Sapphire Reserve revamp. These include a new $300 dining credit and a $300 annual StubHub credit for tickets to concerts and events. Statement credits can be pretty complex, however. Sometimes the annual credit is split into monthly or biannual increments. A $500 credit to the Edit, a collection of Chase luxury hotels and resorts, is split into biannual credits of $250, an amount that won't go too far at these high-end hotels. $250 may not even get you one night, says Sarah Rathner, a NerdWallet credit card expert. In the premium card category, there's a third contender, Capital One Financial's Venture X, which carries a $395 annual fee. Its main perk is its relative simplicity, Rathner says. The card comes with plenty of benefits, such as $300 in annual travel booked through the Capital One portal, and there are no statement credits to keep track of, she says. Chase and Amex may be willing to charge high fees amid economic uncertainty simply to secure wealthy consumers. In the first quarter, bad debt write-offs on credit cards reached 4.7% on an annualized basis, according to Tim Kolk, president of TRK Advisors, which works with smaller credit card issuers. That's higher than any full year since 2011, with the most escalation in the middle market and below segments, Kolk says. Henderson, a Points Guy, also notes the big investment issuers are making to build airport lounges for their cardholders. The credit card companies wouldn't be spending the millions upon millions of dollars it costs to build and operate an airport lounge if it wasn't bringing in big profits, he says. Editorial note, Paul R. LaMonica contributed to that article. Our next headline, what's behind the stupid quote-unquote earnings flood? More companies are using so-called non-GAAP numbers. It makes their results look better, by Andy Serwer. Oracle does it. Bristol-Myers Squibb does it. Sometimes even Apple does it. Yes, these companies have fallen in love with non-GAAP earnings, that is. Even a casual investor will tell you that more companies these days are eschewing plain vanilla GAAP earnings. That's earnings of the generally accepted accounting principles variety, GAAP, in favor of non-GAAP numbers, which tend to exclude costly non-cash expenses like write-offs that make a company look less profitable. The trend's been building for years. The real questions are, how prevalent has this become, and what's the Securities and Exchange Commission doing about it? The short answer's widespread and not so much. A study by Wall Street research firm CalcBench and Suffolk University's Sawyer Business School quantifies the non-GAAP universe. For fiscal 2024, some 351 companies in the S&P 500 index, or 71%, reported either non-GAAP net income or non-GAAP earnings per share. We asked Pranav Ghai, author of the report, if companies were doing this to make themselves look better. Without a doubt, he says, or they would say GAAP makes us look worse. In fact, 89% of those 351 companies reported adjustments making their results look better, CalcBench found. That means 63% of the overall S&P 500 reported higher earnings after accounting adjustments, while only 7.8% had lower non-GAAP earnings. The balance of all S&P companies had no adjustments. That kind of math gives one pause. GAAP was developed by the Financial Accounting Standards Board to provide a standardized set of rules recognized by the SEC for companies to follow to ensure that their numbers are accurate and to prevent chicanery. Non-GAAP numbers were to be used judiciously to explain extenuating or extraordinary circumstances like a factory fire or the sale of a division. Over the years, though, companies, especially tech firms, began to exclude items like stock option compensation in non-GAAP earnings, which they then offered as giving a more accurate picture of their businesses. Today, companies are using non-GAAP earnings to account for everything from amortization of intangible assets to serial restructuring and currency fluctuations. True, they have to reconcile non-GAAP to GAAP earnings, that is, show how the non-GAAP earnings figure is derived from GAAP earnings. But particularly with tech and healthcare companies, non-GAAP numbers are now more accepted than the generally accepted ones. Companies used to say they were going with non-GAAP because GAAP made them look less profitable, says Guy. Now it's just the way the world works. CalcBench has been surveying the S&P since 2011, but this is the first time it looked at all 500 companies. In 1996, PwC found that 59% of S&P 500 companies used at least one non-GAAP measure, not just earnings. By 2020, that had climbed to 94%. Intel had the biggest adjustment last year, according to CalcBench. The chip maker had a GAAP loss of $19.2 billion, but categorized $18.6 billion as non-recurring. So it reported a non-GAAP loss of $600 million. We asked Intel about these charges, and a spokesperson emailed the following statement. We believe these non-GAAP financial measures provide investors with useful supplemental information about our operating performance. The company noted the adjustments entailed non-cash charges. Guy says Apple and Microsoft occasionally include non-GAAP numbers when they're warranted, commensurate with the intention of non-GAAP reporting. Oracle, on the other hand, has booked a restructuring charge every year for the past 5 years, which doesn't sit well with me, Guy says. Oracle declined to comment. I think there are a lot of investors that want to be misled, says Jack Chiselski, an accounting expert and president of investment manager RG Associates. They're going to throw money at anything that puts up better numbers than last year on any basis, whether it makes economic sense or not. And these investors set prices. Companies feed this stupid hunger. As long as the SEC lets them do this kind of reporting within the safe harbors, the frenzy continues. According to the SEC website, generally accepted accounting principles, GAAP, are the accounting standards forming the bedrock of the U.S. financial reporting system. The Commission has been warning investors of various measures of performance for more than half a century. Since then, non-GAAP has only grown in popularity. When we asked the SEC if it was concerned about the rise in non-GAAP earnings and whether it was considering any rule changes, it declined to comment. We also asked the FASB and were told, as a standard-setting organization, we're not in a position to address the difference between a company's GAAP versus non-GAAP earnings. A better source of information would be the SEC. It's a little bit like the days of prohibition. We have rules, but those subject to them find workarounds. We devote huge resources to maintaining GAAP standards. To what end? Valuations of software companies that have leaned into non-GAAP earnings for decades haven't been punished. To the contrary, like banning alcohol, is maintaining the distinction between GAAP and non-GAAP numbers worth the cost? Hold the phone, says Chiselski. No way they should ever make non-GAAP earnings the standard, he says. GAAP numbers are a lot more standard than non-GAAPs will ever be. They're based on a fair and judicious system of rulemaking, not one-off recipes. Makes sense, though investors should expect plenty of creative cooking going forward. Our next headline from the Barrons of June 23rd, Pepsi tries to regain some of its fizz. PepsiCo's split focus on snacks and drinks had been its strength. Weakness in both recently has been a drag on the company's stock, by Evie Liu. Investor confidence in PepsiCo, the multinational conglomerate selling everything from sodas to granola bars, is wilting. PepsiCo's split focus on snacks and drinks had historically been its strength, but now it's dragging the firm down from both ends. Its drinks continue to lose share to competitors like Dr. Pepper, and its formerly fast-growing snack business is being hit by weak consumer spending amid inflation fears, shifting health priorities, and possibly a backlash against ultra-processed foods. Long held by many investors as a steady consumer staples play, PepsiCo shares have tumbled 29% from their recent high on May 17th of 2024 to a recent $129. It badly lags behind soda rival Coca-Cola and the S&P 500, which are up 10% and 13% respectively over the same period. PepsiCo stock is now trading at similar levels as 6 years ago, even though the firm's 2024 earnings were nearly 50% more than in 2019. It's now valued at just 16 times forward earnings, the lowest since 2012 and much below Coca-Cola's 23 times. Investor sentiment is low for good reasons. In 2024, PepsiCo's organic sales rose by 2% from a year ago, but much of the growth was driven by higher prices. When looking at sales volume, beverages in North America shrank 3%, while the Frito-Lay segment, which covers Doritos, Lay's, and many other snacks, dropped 2.5%. The food segment saw some improvement in the first quarter, but volume was still down year over year. Unfortunately, the growth has yet to re-accelerate back to what we've seen historically, says UBS analyst Peter Grom. It's taken longer than people would have expected. PepsiCo declined to comment for this article. To be sure, PepsiCo's overseas business is doing well, especially in emerging markets like Latin America. But weak foreign currencies last year offset the growth when translated back into dollars. In 2024, PepsiCo's international sales grew a little over 2% from a year ago. The dollar has weakened this year, but less so in key emerging markets. PepsiCo said it expects foreign exchange headwinds to continue shaving its net revenue and earnings growth by 3 percentage points in 2025. Tariffs later this year could drive up freight and packaging costs and further squeeze margins, the firm said. In April, PepsiCo said it expects 2025's earnings to be flat from a year ago in constant currency, down from the previous expectation of mid-single-digit growth. For years, PepsiCo has been losing the beverage market to competitors. Last year, Dr. Pepper overtook the classic Pepsi to become the second most popular soda in the U.S. For low-sugar drinks, Diet Coke and Coke Zero Sugar also left their Pepsi counterparts far, far behind. What's the problem? Distracted by its large snack portfolio, PepsiCo's lower marketing spending on beverages than rivals led to fading brand awareness. The company's also been slower to introduce new products to snack buyers in a fast-changing market. Unlike Coca-Cola, which mostly relies on independent bottlers, PepsiCo owns most of its bottling and distribution infrastructure. That's become yet another problem. Trucks are visiting stores less often, and shelves aren't always well stocked. That means that even when shoppers wanted PepsiCo drinks, they often couldn't find them in stores. Still, until 2023, the stock continued to climb, thanks to PepsiCo's crown jewel, its snack business that persistently delivered strong growth and higher margins. That's no longer the case today. PepsiCo snack sales have been hit hard by weak consumer spending amid inflation and recession fears, and many price-sensitive shoppers are skipping the snack aisle or trading down to cheaper private label products, hurting big brands like those from PepsiCo. PepsiCo has raised prices too much over the past few years, says RBC Capital Markets analyst Nick Modi. It's not just about taking the price, but how they did it by shrinking portion sizes, he told Barrons. That might have angered some consumers. The popularity of weight loss drugs like Wegovy, which makes people eat less, has further weighed on demand. The fitness trend and aging population has pushed more consumers toward protein-rich food. But PepsiCo's snack lineup is mostly high-fat, high-sodium carbohydrates, such as Doritos corn chips and Lay's potato chips. While the firm made a big push to trot out new flavors, such as Valentina and Lime, and wavy Korean-style fried chicken Lay's potato chips, it has lost focus on the core value and appeal of its brand, says Modi. If you innovate too much, you just create confusion in the eyes of consumers. PepsiCo's working to fix these problems. Management is slowing price hikes for snacks, pushing multi-packs and smaller packages to lower per-unit costs and help with portion control, and leaning more into better-for-you products that have less sodium, saturated fat, sugar, and artificial ingredients. In January, PepsiCo acquired Siete Foods, a Mexican-American brand known for grain-free tortilla chips with avocado oil. The company increased its stake to acquire full ownership of hummus brand Sabra, another snack category that's gaining traction. For a beverage revival, the company has rebooted its Pepsi Challenge campaign from the 1970s and 80s that praised Pepsi as the better soda to pair with food. Last month, it acquired fast-growing prebiotic soda brand Poppi, which contains dietary fibers that support gut health. Management's also trying to better integrate PepsiCo's food and beverage businesses both in the back office and the supply chain. PepsiCo currently sends separate trucks for food and beverages to the same stores, instead of transporting them together to reduce costs. Grom thinks that the stock market's reaction might be overblown. PepsiCo is still delivering growth that, while not where it has been historically, is decent, he says, noting that the firm's first quarter results were better than some Staples peers thanks to its strong international growth. While a bounce back in share prices might take some time, he says, further downside appears limited as well. I think the risk-reward for the stock is attractive now, says Grom. At this valuation, not much expectation is priced in. He has a buy rating for PepsiCo shares with a $169 price target. The depressed stock price could be a good opportunity for income investors to jump in. PepsiCo shares now have an attractive dividend yield of 4.4% according to FactSet, and management plans to raise dividends by another 5% later this month. Still, most analysts on Wall Street remain on the sidelines when it comes to PepsiCo. Among the analysts polled by FactSet, 2/3 had a hold rating for the stock with a median price target of $147. That suggests a 14% upside. PepsiCo management's recent efforts, while laudable, likely won't help the stock bounce back soon, says RBC's Modi. I think it's a very near-term oriented approach, he told Barrons. I'm sure it'll help their margins, but I'm not sure it's going to solve their top-line problems. There's a lot of wood for them to chop. He has a hold rating with a $148 price target. Although defensively positioned in the past, PepsiCo's turnaround in Frito-Lay and protracted market share decline in the U.S. are a drag into a potential recession this time, wrote Bank of America's Brian Spillane in April. He downgraded the stock to neutral from buy and lowered his price target to $155 from $185. PepsiCo is expected to report second quarter earnings July 17th. Changing investor views on the beverage and snack giant may require clear progress, such as the volume of Frito-Lay sales swinging back to positive growth. Investors will be watching closely whether the fizz at the soda giant can return. Our next title: Pinterest is a standout social media stock. Its innovations make it a buy. The stock has dropped 62% from its all-time closing high in February of 2021. Recent changes to its platform should help boost shares. This is reported by Jacob Sonnenschein. Being in the middle of the pack isn't easy, especially in the high-stakes world of social media. Don't let that stop you from buying shares of Pinterest, which is what it takes to succeed online. Pinterest, the $23 billion market cap platform for exchanging ideas on recipes, fashion, home products, and more, has had a tough time since COVID-19 lockdowns caused its business to boom. Its stock dropping 62% from its all-time closing high of $89.15 in February of 2021. The concern now isn't about the pandemic-driven excesses, but slowing near-term growth. Pinterest has also made changes to its website to try to spur ad spending, but that's raised concerns about whether its users would stick around. In a social media world dominated by TikTok and Meta platforms, the worry is that Pinterest will end up an also-ran with a declining audience. The story doesn't have to unfold that way. Pinterest's changes could help boost advertising spending over time, while concerns about alienating users may be overblown. Even the recent sales slowdown can be blamed on one culprit: food and beverage advertising. Without it, Pinterest sales growth was a percentage point higher over the past year and a half, according to Wedbush Securities data. While the stock has begun to recover from its recent drubbing, it's gained 18% so far this year, there's still more room. While we recognize macro uncertainty and certain vertical challenges, we are encouraged with engagement gains, a greater share of ad budgets, and operating efficiency, writes Citigroup analyst Ron Josie, who has a buy rating and $41 price target on Pinterest stock, up 20% from Friday's close of $34.22. The bull case for Pinterest starts with the changes the company's made to its site. It already invested hundreds of millions last year in artificial intelligence to show the right products to each user, something BMO Capital Markets analyst Brian Pitts says has increased click-through rates, the percentage of time users click on an ad, all the way to brands' websites for purchase. The company has also rolled out performance tracking, which enables brands to more precisely calibrate their ad spending, giving them more visibility of their returns, and keeps them on the platform. Management announced that they're doubling down on visual search capabilities, which should begin to scale up the number of ads and increase monetization, writes Pitts, who also has an outperform rating and a price target of $40 on the stock, up 17% from Friday's close. It already seemed to be working. Wedbush analyst Scott DeWitt surveyed hundreds of advertisers and found that 3/4 of respondents who advertise with Pinterest intend to up their spending on the platform by at least 10% this year, up from just half in the fourth quarter. Pinterest has a significant opportunity to unlock incremental wallet share gains, writes DeWitt, who also has an outperform rating and a $40 price target on the stock. Even incremental wallet share could provide a major boost for Pinterest. The company gets just $6.94 in revenue from its average user, an industry metric known as ARPU, A-R-P-U, a fraction of Meta's $52, and roughly half of Snap's $12 and change. As Pinterest increases the number of ads on its pages, it only needs to grab a few $100 million more of the $500 billion advertising pie each year to grow sales in the low to mid-teens, in line with the 15% annual growth analysts expect over the next 2 years. A recovery in food and beverage advertising and more spending from other currently light spending sectors would also help. The food and beverage vertical has seen ad spend growth stabilize at 7% year over year in DeWitt's recent check. Automakers, financial services, and technology companies, meanwhile, which contributed only about 5% each to Pinterest's 2024 sales, could become a growing source of advertising. They spend just $394 million on Pinterest, or just a fraction of the $95 billion the industries spend on advertising in the U.S., according to Wedbush. Of course, Pinterest can't grow its ad revenue if it's losing users, but so far, changes to the site don't seem to be causing attrition. After the company tweaked its platform and increased ads, user growth in the first quarter was still 10%. I adapted pretty quickly, says Brooklyn-based apartment owner, graphic designer, and Pinterest user Emily Rowan. I'm pretty neutral about the new redesign, but I do like how easy it is to customize the home feed based on specific boards. If all goes well, adjusted earnings could grow 28% a year over the next 2 years, reaching $1.47 billion by 2026, as margins get a boost from the fact that sales growth will far outpace spending on marketing and employees. Pinterest shares seem far too cheap for growth like that. They came into this year extremely cheap, trading at 15 times analysts' expected earnings for the coming 12 months, below their 3-year peak of 37 times. They still look like a bargain at the current 17.9 times, which is far less than Reddit's 80 times, though the companies have similar market values. Pinterest may never get to those levels, but it doesn't need to for it to be a profitable investment. Stick a pin in it. And with that, we've come to the end of our reading of Barrons magazine for June 23rd of 2025. This is your reader, Eric, saying be well, be safe, look after each other. Remember our veterans, especially those we've lost recently. Bye for now.